Coming up next on Another View, it's tax time. Tax professionals all over Hampton Roads are busy filing returns and helping customers navigate the tax system. And we're happy to have two of them with us today to address your tax concerns. So what exactly is the Earned Income Tax Credit? What are the newest deductions and credits available? How do you find a reputable tax preparer? Or should you just do your taxes yourself? The phones are open. Call us at 440-2665 or 1-800-940-2240 with your general tax questions. We're ready to take your calls right after this news from NPR.
Discussing the issues and celebrating the successes of the African American community. This is Another View.
And good afternoon, everyone. I'm Barbara Ham-Lee. Welcome to Another View. So April 15th is about 6 weeks away, the deadline for filing your 2011 taxes. So we thought we'd take some time here on Another View today to talk about taxes and answer your general questions on the subject. We've asked two tax professionals to take some time out of their busy schedules to spend some time with us. Please welcome Rhonda Hayes, a tax preparer with H&R Block. Hi, Rhonda.
Hi, thank you for inviting me
today. So happy to have you here. And Asar, President and CEO of G&G Associates, a tax and financial consultant service company. Asar, welcome to the show.
Thank you for having me.
Thanks so much for joining us. And we want to take a lot of your calls today, so call us at 440-2665 or 1-800-940-2240 with your general tax questions. Our experts here are good, but they cannot delve deeply into your specific tax issues. But if you have general questions about your 2011 taxes, give us a call, 440-2665 or 1-800-940-2240. Asar, I'm going to start with you. Since we have so many different ways now to file. You can file electronically. You can do it yourself with a software program. Are you more busy in terms of doing the one-on-one or less?
I would say about the same. And actually a little busier. Even though we have the software that people can do on themselves, the software is really just as good as the person that's inputting the data as well. So it depends on if you have a very difficult tax situation or if you have something that's out of the norm. I always encourage folks to really just go ahead and seek a professional. Most of the times there, because the software, I can't even count the many times I take taxes and have to redo them again because people are trying to use the free software or the paid software and try to do it themselves. Because again, the software is only good as the person is inputting the data.
And so if you don't know the right data, then you're having a problem. Rhonda, you find the same thing?
I do. In the tax office, we have people come in all the time with their taxes and they've missed out on something, but it's better to have a professional do the taxes, I think, anyway, and bring your taxes in because we take classes to prepare taxes every year, and we do the tax update, and there's so much more involved in taxes than what the individual knows.
So what are some of the common things that people miss? I know you and I talked about this a little bit earlier in terms of the deductions that they are allowed and the credits that they are allowed to take.
Okay. I think most of the time most people miss the credits, the earned income tax credit or the dependent care credit and there's so many other credits out there, that they can use, the child tax credit, if your children are under 16. There's so much, and even the home energy credit where people who have homeowners, sometimes they miss out on something they've done to their home or energy saving credit for their home. And when they come in, they don't have that or they don't know that they can use that, and we try to get them up on that.
Asar, can you tell us in layman's terms what's the advantage of the credit versus the deduction? I mean, what's the difference?
Okay. In layman's term, a credit is basically a dollar for dollar credit back to you based on whatever the amount of credit you receive, versus the tax deduction. That amount comes back to you based on your tax bracket. For example, let's say you had a $1,000 tax expense or something that you're trying to deduct. But if it's a credit, you would get $1,000 credit reduced and come back to you.
Okay.
Where if it's at a deduction, let's say you're in the 25% tax bracket, federal, so you would get actually 25% of that $1,000 deduction. So $250 would be what you would receive back as a deduction back to you in reduction.
Gotcha. But the credit, you'd get the full amount.
The full 1,000.
Okay.
Correct.
So that's the reason why that's so important, Rhonda,
Yes.
to have people to pay attention to those credits that they can get. So I was unfamiliar with the earned income tax credit. I kept hearing, and then in the past year or so, a lot of discussion about that. So who wants to tackle what that is?
You can have it.
Well, the earned income credit really is a credit for, they say, low income earners. So I always get this all the time. You'll have someone maybe has getting unemployment, or maybe the person didn't even have any employment at all. And again, it's earned income. So you have to have earned income come into your home to be able to get this credit. So this is basically, it has income bracket limits. So you can't make so much money, but you have to make some income. So it's sort of like a pyramid. Sort of, when I say it goes up to a certain level where you can get this maximum credit, but then if you make too much money, the credit starts to come back down again to how much you can make. So that's what the earned income credit really is. And that, unfortunately, is one of those things that people take advantage of, because typically it's low income earner folks. So you see a lot of people that take advantage of this credit, but then miscalculate the credit incorrectly. But there's a lot of rules that come with this credit. Who can take it, who can't take it. And so a lot of tax preparers out here take advantage of people in this area because, one, they're low income, maybe don't have the knowledge and understanding these credits. But then there are specific things that you need to be able, specific criteria you need to be able to meet to be able to qualify for this credit as well.
So if you don't have a tax preparer who understands what that is, they could take advantage of you in terms of either not applying the correct credit or allowing you to get back what you should?
Absolutely.
Is that what you mean?
Yes, they could take advantage of you all day long. You might have tax preparers that might overcharge you because they know people are not very aware of this credit. A lot of people think it's free money, which it kind of is when you talk about the credit side of it. So you get a lot of people that come and want to get their taxes done immediately, and so people overcharge them with fees and all those types of things. So if you don't calculate correctly, and you make sure you meet the strict criteria that IRS has that says who can qualify for the credit, then you can get yourself subject to a lot of penalties and interest and unwanted things that you wanted to get from the IRS.
Okay. Actually, our general manager, Bert Schmidt, has put on our Facebook page, he wants to know what are the big changes in the tax laws for this year's filing. Go ahead.
Well, some of the big changes, when you talk about more so the big changes is, I look at it from the business side. To be honest, there's really not a whole lot of big changes from the personal side of the house, because it's the business side where the big changes come, with payroll taxes being a big one. Employees or employers being charged more for payroll taxes or paying more in payroll taxes, not going to affect the individual person, but this has a big effect on how much money is going out your business to paying some of these payroll taxes. Changes in some of the vehicle expenses, some of the tax deductions you can have when it comes to depreciation, other things like that. Those are where the big changes come from in this year's tax law, because really, to be honest, in 2012, because we're in an election season, nothing big is going to happen. This is just politics. So you're not going to see a whole bunch really take place this year, but next year, I guarantee you there's going to be some big changes after the election takes place.
Well, one change this year was the Schedule M that is not available for this year.
Okay, so explain what that means.
That was the Obama credit where you got $400 or $800 per couple, and they do not have that this year. That was eliminated.
Asar brought up a point, and I want to ask you about it, Rhonda. So if you get unemployment, if you've been unfortunately unemployed, do you still have to file?
Yes, and some people have federal withholdings taken from their unemployment, so they would definitely have to file to get some of that back.
Okay. Let's see. Peggy joins us from Virginia Beach. Hi, Peggy. You're on the air.
Hi.
Hi. You're on the air.
Yes. My question is, my husband and I purchased a home. We closed on May 15th, and we do our own taxes, and we were wanting to know, we were looking through the books, and we couldn't find as far as getting a tax credit for being first-time home buyers, or if we could deduct our closing costs from our income.
Did you closed last May 15th, or you're closing this May 15th?
No, we closed last May 15th.
Okay. Asar?
Yes, you can deduct some of the closing costs that you may have. For instance, the points that you have since your new home, so you can deduct some of the points that you have on there. You'll have, for instance, some of the interest and taxes, the things that come into closing costs, you'll be able to deduct. So one of the important things you want to do is to make sure that you give your tax preparer your closing documentations, the spreadsheet that they give you as far as called like the good faith estimate, which has all your breakdown of your fees. Make sure that you bring or give that to your tax preparer, and that tax preparer should be able to help you understand some of the things that you will be able to deduct on your tax returns.
Okay. Now, I know in 2010 there was a first-time home buyer's credit. Is that what it was called? And they don't have it for 2011?
Go ahead,
Yes, that is correct, and that has closed, yes.
Okay.
Except, there's one exception to that. One of the exceptions is if you actually are armed services, your husband, or you might be in the armed services or a foreign worker that worked overseas. If you actually purchased your house or had started the process before May the 1st of last year, May the 1st, 2011. You didn't have to close till June, but you had to at least have started the closing process. If you were in the armed services or something like that, then you could still qualify for that credit, which is up to $8,000 for armed services or foreign workers.
Okay, I have one more question. With this loan, we bought a distressed property, and we were able to get a rehabilitation loan through Freddie Mac, which was a $30,000 loan. You said there was energy-saving credit that we could claim, and then in that renovation loan, we put in a new heating, cooling system, and new windows, which would be energy-saving, and new energy-saving appliances. How could we use that money, or could we use that money?
Yes, when you had the work done, they would have given you a certificate that says it was energy saving, and you would put that number, whatever it cost you, on the taxes on that form for the energy saving credit. And it would, if you go to a professional, of course, we would do the math for you, and you would get a credit for that.
Okay. Peggy, thanks a lot. We appreciate your call. 440-2665 or 1-800-940-2240. Tasha joins us from Hampton. Hi, Tasha.
Yes. Currently, I'm retired military, and I actually have a GS job as well. And my CPA has worked with me, and I continue to owe taxes every year. And we made adjustments every year, but I'm not necessarily learning why. Why am I, if any of you have any insight on why I continue to...
I feel your pain. Asar, you want to take that?
Yeah, I'll take that one. That's actually one of the biggest things I see, because the majority of my clients here in this area, I say maybe 60% of my clients here are ex-military or retired military or now working again. And this is a common mistake I see all the time. For example, a military member will receive a retirement check, and that retirement check is taxed at a certain tax bracket based on that income. But then they have another job that's over here, and they're making another amount of income, and so that's taxed at that tax rate. The military retirement check doesn't know about the job doesn't know about the military retirement, but when they do their taxes at the end of the year, Uncle Sam doesn't care, but all they want to know is the total income to combine. That total income combined would typically be higher than what the military retirement income tax bracket is. So, for example, let's say someone's making $70,000 on their GS job, and they're probably getting a retirement check of $30,000. The $70,000 income is probably, if they're a married couple or a single person, for example, be in the 25% tax bracket. Well, the military retirement at 30%, that would probably put them in the 15% tax bracket. So you have a gap of 10% there. So they're probably paying 10% less in taxes in which they should be paying on their military retirement, and that's typically the reason why they owe. But they could do a simple thing as just adjusting the W-4, or come in and get your tax professional to help you calculate the exact amount you need to have, so you can just have your military retirement come right out of there.
Okay, Rhonda, you want to add to that?
Oh, I agree with him, definitely. Adjusting the W-4 is the thing to do, especially with the military retirement. You can call them and have them have more taxes withheld.
Okay, Tasha, I hope that helps you out.
And one
Thanks
thing
for
I
calling.
will
Go
tell
ahead.
you, just for you to know, I actually do live webinars and free webinars, and one of the webinars I just did this Tuesday that just passed was on the W-4.
Good.
So actually, if you go to my website, you can actually download it as a free webinar. If you go to www.gngassociates.net, click on the newsletter link, you'll see a link in there where you can actually pick up and go and view the actual live webinar.
Okay. Lewis from Williamsburg joins us now. Hi, Lewis. You're on the air.
Hi, thank you for taking my call.
Okay.
I have a question regarding FAFSA and college fees. My son is in his second year, received a 1098 from his university stating, how much was covered and how much was not. But I don't, I paid some of the leftover fees, he paid some of them, and I'm a little confused about who can take what on their taxes.
Is he your dependent?
Yes.
Okay.
Mm-hmm.
If he is your dependent, then you can get the education credit. And if you receive the 1098, that should tell you how much tuition he paid or billed for and how much scholarship and grant money that he received. And the difference is between the two is what you actually borrowed or paid, and that is the amount that you were put down for the education credit. And that is a wonderful credit because that's a refundable credit. You can get up to $2,500. Or if you don't qualify as much, up to $1,000, it's a wonderful education credit.
That's great. Now, he also works, so I'll have to file his taxes, but only one of us can claim that. Is that correct?
Correct.
Yes. Did you want to answer that, Asar?
Yes, one of the things, they have the American Opportunity Credit and the Hope Credit. The difference between the two, the Hope Credit is usually for the first 2 years of school, but the American Opportunity Credit is actually for the first 4 years of school. And then one of the things I always see taxpayers forget about is that, which is not like the Hope Credit, you can only claim, as you say, on the 1098 that you receive, you can only claim those fees. But with the American Opportunity Credit, you can actually include books and fees like lab fees and things of that nature. But that's not going to show up on your 1098. So you have to just kind of keep track of the record of those expenses that you have, like books and lab fees and those types of things. Okay, so don't forget about that when you bring in your taxes to your tax preparer.
Thanks,
Thank
Lois.
you very, very much.
We appreciate your call. Thank you. 440-2665 or 1-800-940-2240. Give us a call if you have any tax questions. Charlene joins us from Suffolk. Hi, Charlene.
Oh, hi. Thank you for taking my call.
Absolutely.
My question is, I got married last July,
Congratulations.
July 30th. Thank you. But I don't know whether I should file as single or married now, since for half of the year I was single, and then for the rest I was married.
Rhonda?
It's married.
It's married?
Yes, it is. Or you can do married filing separate. Those are the two choices that you have. And you kind of do the calculations to see which one works better for you.
Okay, great.
Asar,
Thank you.
You want to add anything to that?
Yes, but most likely, unless your husband now owes some kind of debts or has some things that you don't want to be responsible for before you got married, it's going to probably be more advantageous for you to file married filing joint.
Again, I filed married.
I said, unless your spouse, maybe before you got married, might have had some debts that he owed, or maybe had some bills that he didn't tell you about that might be taxable, as far as where the tax authorities might take your refund. It's probably always more advantageous for you to take married filing joint versus married filing separate.
Okay.
And even if he did, then you can do the injured spouse.
Right.
There is a form for that, too.
Oh, okay.
But make sure you file that before you do it, though.
Yes.
Okay, great. Thank you so much.
Thanks for the call, Charlene. We appreciate it. Okay, so let me turn this around. Suppose you got divorced in 2011. Which way do you file now for this year?
Had a household or single?
Had a household or single? Okay.
It's according to your...
So you don't have to divide the year. Say if you got divorced in July, you were married for half the year, you single the rest of the year. It's still based on single.
If you were married one day out the year, you can file married but I would recommend you file single. You can file married filing joint. You actually can file married filing joint if you got divorced. But then you take the risk of that, depending on how the marriage split up.
And what
does that spouse give you that other part of the money? So.
I have one person who she remarried, of course. She got a divorce and then remarried, and so she's wondering how she should file. Of course, she's filing married filing joint with her husband now.
See, there you go. 440-2665 or 1-800-940-2240. Okay, we've heard in the news lately about this company that had major problems with taxes in our area. The company was called Mo Money. Not only problems here in Hampton Roads, but in Memphis and other cities across the country. And as a matter of fact, Bobby Scott and a congressman from Tennessee just yesterday went back to the IRS again and other federal agencies to try to get some relief for the patrons who either have not received their returns or received less than they anticipated, et cetera. I don't want to get into the meat of what's going on with that company, but my question to the two of you is, how do you find a reputable tax preparer? What do you look for? What are the questions that need to be asked before you throw down your life in terms of the numbers? Rhonda, you want to start?
Okay. Well, I think because, like I said before, we take classes, and you should look for someone who is familiar with the tax laws, who knows about the updates and everything that is involved in taxes, because it's very complex, and I would recommend anybody seek out a professional who is experienced.
Mm-hmm. Is there any kind of certification that you need?
Not at this time, but next year I think the IRS is going to certification for tax preparers.
For tax preparers starting next year. Okay, Asar?
Well, I'll be honest, I didn't know anything about Mo Money until about 2 weeks ago. My my business associate told me about Mo Money tax service, and I was like, Mo Money, I don't even know anything about, but I didn't even look them up till this week when you asked me to come on to the show. So let me go look up the company. And so I went and I asked myself for, as far as a reference for a tax preparer who you're looking for, treat your tax preparer like you would your bank. Would you go to a tax preparer, to a bank named Mo Money Bank? So I asked you that same question. Why would you go to someone named Mo Money Taxes? And then if you look at the commercials, that's all over YouTube, and you would go to a bank called Mo Money Bank that had commercials like that.
So basically pay attention to their marketing, pay attention to the way that they present themselves, and expect the same types of professionalism that you would expect in any other field.
Absolutely, because that's very important. I try to get folks to think of this from a philosophical standpoint. You pay taxes out of every one of your checks, 12 months out of the year if you're working. So that's one of the criteria I look for. Look for a tax preparer that's available to you all year round. Because if you paying taxes all year round, you should have someone that can be readily available to answer your questions all year round. On that same standpoint, have someone that the person who did your taxes to be able to get in contact with them all year round. So a lot of folks and a lot of businesses are only open maybe 4 or 5 months out of the year. Have someone that's available to answer your questions 12 months out of the year, because in essence, the average person is in the 25% tax bracket. And if you include state, like for here in Virginia, that's 5%, around 5%. You're talking about 30% of your taxes, of your paycheck is going to taxes. That's a lot of money. Depending on how much money, I don't care how much money you make, 30% of your check going to taxes is a lot of money. So you want to make sure you take your taxes as serious as you would take your finances in your banking.
Okay, there you heard it. If you're just joining us, we're talking about this year's tax season with tax professionals Rhonda Hayes with H&R Block and Asar Gray, President and CEO of G&G Associates, a tax and financial consultant service company. And the phones are jumping off the hook here, so let's go to line 3. Carol joins us from Suffolk. Hi, Carol. You're on the air.
Oh, good morning. How are you? Thanks
just
for
fine.
Thank you for taking my call.
Thanks for calling.
You're welcome. I'm a college student also, and I just happened to turn on the radio to Mr. Ray's answer regarding the tax credits, and I wanted to thank him because he articulated that very well. However, one piece of information that I think is important for students to know as well, I myself am a recipient of Pell Grant. So because I get Pell Grant, I'm not able to utilize the HOPE or the American Lifetime Credit because most of my fees are paid for, well, actually all of them are paid for by Pell Grant. So students need to remember that if they do get Pell Grant or other grants, that may decrease what they can claim because the government gives them money that's free and tax-free to pay for their education.
Asar?
Yes, that's correct. On that 1098, you'll see on there, it asks you about how much you get in your grant. So that's why you want to give that to your tax professional, because on there you have the amount of your scholarship as well as the amount from any grants or scholarships that you receive. So that's where your tax professional would actually sit there and reduce. If the Pell Grant, of course, is higher than what you receive, then your paid in tuition, of course, there would not be anything that would be coming back as far as credits. But if your scholarships or Pell Grants or any other grant that you might receive is less than the college tuition, then you still would be have an option to be able to receive some income back. And again, if you're talking about the American Opportunity Act credit, in that calculation that would be on your 1098, they do not include books, fees, lab fees, any other things, especially if you're like maybe a nursing student, other kind of fees that the typical people don't have when they're going to school. So those calculations aren't included on that 1098.
Okay, Carol, thanks so much for calling. We appreciate it. Let's go to Tony in Portsmouth. Hi, Tony.
Yes. I'd like to know if your husband, my husband has a really low income because he's disabled, and I have a higher income that I'm working. Mm-hmm. Would it ever be advantageous to file separately, or is it always advantageous to file married, together?
I think married filing together, joint, is the better way to go for you, especially if his income is low. It does help. It helps you.
Because he has a lot of medical bills, so I thought maybe we could get his credit that way because it doesn't come to 7.5% for both of us together.
Oh, okay, so you don't have to itemize, is what you're saying. Okay.
Well,
yeah.
Are you able to itemize his medical bills? Are they enough?
They would be for his income, but not ours combined. You see what I'm saying?
Right.
I don't get any credit because of ours combined, but if they did it on his by itself, I'm thinking that it would be more,
Right.
More.
Right. Well, to itemize just the medical, I mean, you would probably need some other itemizations like mortgage interest, personal property taxes, and their contributions and other things to itemize also.
And we do have all of that.
You
so
do.
Would it be, if we put all of the deductions on his income, would that be something to look at?
Well, if you do it separately, you would need to split the deductions also because, yes.
50-50, or is that how it works?
If you itemize, he would need to itemize also.
Oh,
so in other words, she can't itemize, not itemize, and give all the deductions to him for him to itemize.
Right.
You can't do it that way, Tony.
Okay, that's what I was wondering.
Thank you.
Right.
Thanks so much for calling. We appreciate it. 440-2665 or 1-800-940-2240. Let's see. Sean joins us from Suffolk. Hi, Sean.
Hi.
Hi, go ahead. You're on the air. And turn your radio down, please.
Okay.
Thank you.
Sure will.
Okay.
My question is, I've been hearing on the news lately about the CFR 26, about the amending taxes for the veterans. And I was wondering if either one of the tax professionals were familiar with that.
Asar, are you?
Yes, I'm actually familiar with that. It's actually a tax deduction that if you are in the military or were in the military and you retired 20 years or greater in time in service and you have a disability of right now just finding out it changed to 50% or less, that you might be eligible for this tax deduction called CFR 26. Actually, this is one of the things that a lot of veterans have helped veterans over the last several years be able to get back huge refunds on. So if you go to my website, actually I have information on there. You can actually check that out, or you can just download the CFR from, just go to Google, CFR 26. It stands for Code of Federal Regulation 26, and you can actually download the regulation. And then it kind of explains it a little bit there for you.
So this is for veterans who have been injured?
This is basically not necessarily injured. Well, when you're in the military, when you get out, a lot of veterans get what's called a disability. And it could be maybe they had a child, had marks, or maybe they didn't necessarily have to be injured in a wartime environment.
Oh, okay.
So when they get out of the military, they might have a disability rating anywhere from 0 to 100%. And so they'll get basically tax-free income that'll come in, and they're supposed to get a credit to some of their taxable income, which is from their military retirement. But with the CFR 26, the way the rule reads, a lot of folks that aren't getting it calculated appropriately as far as the way, because of the change that the VA changed their rules, the way disability payments are going to be made to veterans. So you have to go and recapture that amount. And so if you don't recapture it, because the IRS won't let you go back 3 years, if you don't recapture it, then you miss out. For example, April 17th coming up here, April 17th, 2012, if you don't put in for that recapture or that amendment, you miss out for 2008.
For 2008. Gotcha. Okay. Let's see. Mike joins us from Norfolk. Hi, Mike. You're on the air.
Hi. How are you doing?
Okay.
All right. Yeah, my question is, if you are providing providing maybe $4,000 or $5,000 a year for the care of my parents, am I allowed? Is there some type of rule or standard that allows me to use that on my taxes?
You mean to claim your parents as a dependent?
Yes.
Okay. The parents, and that's people that they don't even have to live with you for you to carry them, because on your taxes, if you provide support for them, and you would have to provide more than half of the support for them.
Okay.
So he'd have to pay for more than 50%
Right.
of their care.
Of their care, that's correct.
Oh, more than 50% of the care. And you just stated, would they have to be living with me or not?
No, they do not have to be living with you. The parents are the only ones.
Right. Well, it's only one parent, but how do you determine if it's more? Well, I guess to determine more if it's more than 50% of their expenses. Do I have to bring receipts or anything like that, or?
Well, what you would determine what they receive, what your parent receives as income, and if you're doing more than half of what they receive, also, then yeah, you do. You
have to look at the parents' overall income for the year,
absolutely.
And then if you paid more than 50% of that, that's when you can take the deduction. Am I correct in that?
Yes.
Correct.
Okay, yeah. Okay, great. That's very clear. And I guess I'm paying 100% then. So.
You're doing great.
I'm sure your mom appreciates it.
Yeah.
Absolutely. Thanks for calling, Mike. We appreciate that. 440-2665 or 1-800-940-2240. Our producer wants to know about, is there ever a cutoff for paying taxes when it comes to age? So in other words, if you retire, Asar, can you stop paying taxes?
If you have income, as far as the IRS concerns, they want a piece of it. There might be some income limits as far as based on your standard deductions, or if you have itemized deductions that necessary where you might not owe any tax, might not have a taxable income. But as long as you break that criteria for standard deduction or itemized deduction limit, head of household, or whatever the situation might be for you, if you have more income than that deduction that the IRS gives you, you will owe taxes on that. Pretty much, if you are working, as the IRS has said, there's three things are going to happen. You're going to die, you're going to get old, and you're going to pay taxes. And so as long as you have enough income where the IRS feels that you can owe them some money, then you're going to pay taxes.
Now, but if you're just getting Social Security, Rhonda, do you have to pay taxes on that?
No. If you're just receiving Social Security now, if you have another job, then you would have to file taxes.
And that falls in that income bracket threshold I was telling you about. So if you're making more income than that threshold, then yes, you would pay taxes on that.
Okay, here's the question that nobody wants to hear, but what if you owe? Some people try to dodge, they don't want to pay, they don't want to. Talk to me about what happens when that professional sits down and says, okay, Mr. Jones, this is how much you're going to have to send the IRS. Do you have to send that money with your tax return? Let's start with that, Asar.
No, you don't. The IRS gives you options. And you always tell folks, first of all, if you owe, don't get nervous. So many people get nervous because they might owe the IRS. First, let's find out why you owe. That's the first thing, so we can correct that for the next year. Mm-hmm. Second, if you do owe, the IRS gives you many options. You can either do an installment agreement, which is a fee. The IRS charges you for that. Or you can actually pay at a later date. Just realize that you're going to have interest and things of that nature that's going to come after the 17th of that month, of the 17th of that this year. Mm-hmm. So the key there, though, is to make sure that you figure out why you owe, correct it for next year so you don't owe it the next time.
Okay. Rhonda, you want to add anything to that?
Oh, that was very good. Yeah, I agree with them.
Okay. All right. Bob joins us from Virginia Beach. Hi, Bob. Oh, you're actually from Isle of Wight. How are you?
This is Bob, and I'm in Virginia Beach.
Oh, you are the one in Virginia Beach. Okay. Yes. I apologize. Go ahead. What's your question?
I have a question. I have an equity credit line on a rental property, and I pay interest, of course, on that. And I'm wondering, do I declare that on Schedule A or Schedule E?
Rental is Schedule E.
So there's no way to put it on Schedule A then?
Not for the rental.
It's actually more advantageous for you to put it on Schedule E than a Schedule A, just to let you know.
It would be, except that the amount of income that I get from the rental is not enough to make this significant, because I can't deduct any more from that than the income that I get, and so it would actually be better for me to put it on Schedule A if I were allowed to.
We've got some perplexed faces going on here, so that may be a little more technical than we have the expertise for right now.
Research.
Yeah,
we need to do some
I mean, I'm trying to do the math, and I understand where the Schedule E comes in on line 17 or 16 or 17 of your 1040. So anytime you have deductions that come in off of that income, it's always more advantageous than you getting itemized on, which is page 2 of your Schedule A, which will be on your page 2 of your 1040. So if you're saying that you're trying to offset some income from your Schedule E, any deduction is going to be more advantageous to come off of that versus your Schedule A itemized deductions.
Well, what I'm saying is that I already have expenses on the Schedule E that more than equal the income that I get from it, even without when you factor in the mortgage interest. Just on the mortgage of the place, not the equity credit line interest, but just the mortgage and other expenses, that already is more than the income that I get from the rental property.
Well, you can take a loss on the
Schedule E. You can take a loss, so that's why it's more advantageous to put it on the Schedule E.
You can take a loss.
You can take the loss. That's actually be better.
A negative number.
So you can have a negative number on it.
Yes.
Oh, thank you very much.
You're welcome, Bob. Thanks for calling. We appreciate it.
Without a doubt, seek professional help with that one.
Yes. Okay, Bill joins us from Isle of Wight. Hi, Bill. You're in the air.
Hi, Barbara. How you doing? I missed you on Friday nights on television.
I appreciate that, Bill. Maybe one day we'll get back there. Who knows?
I hope so. I've got a quick tax question for your guest. I have a tax bill due, and I wanted to pay by credit card. And I've called the 800 number and found out there is a 3% fee of total to do that. Is there any way to avoid what I consider a frivolous fee for wanting to pay by credit card?
Asar?
I recommend you to go write a check and mail it in, and you can avoid the 3% fee.
Our money order.
Yeah, I wanted to I have a credit card where I can get some points, and I wanted to try to build up some points with this tax thing and at least make that worthwhile. So,
that 3% may be in your way, I think, huh?
Okay, but other than that, there's no way to avoid the 3% fee.
No, they charge you a 3% fee because that's what the credit card companies charge you.
Oh, okay.
That's the reason why they're charging you. Like most credit card companies charge a 3% fee for the transaction.
To the IRS.
To the IRS. So the IRS is just making you pay the fee.
Double indemnity or whatever it is. All right. Well, thank you. I'm enjoying your show.
Thank you so much. We appreciate the call. Take care. Write the check. You said write the check. Right. Okay. Renee joins us from Hampton. Hi, Renee. You're on the air.
Yes. Hi. I have a quick question. I sold my home in 2011, and I just wanted to know if I have to report the gain on that sale now, or can I wait within maybe 2 years and see if I'm going to purchase another residence?
There's a $250,000 exclusion on the sale of a home, that capital gain. So you can report the sale of the home, but you wouldn't have to pay taxes on the gain if it's not more than that.
Is that one-time exclusion?
Well, I think the rules have changed on that some, but yes.
Okay, so they don't have the rule where you have to be a certain age for that exclusion?
No, not age involved in that.
This was a personal home, correct?
Yes.
No.
Right.
There's no age limit there.
No.
It's $250 for single and $500 for a married couple.
Exactly.
Okay, and that's $250,000.
Yes, $250,000. Yes.
Okay, you're welcome. Thanks for the call. 440-2665 or 1-800-940-2240. Rhonda, when people come into your office, what's their attitude about having to file their taxes?
Well, most people are pleasant, and they come in to get their taxes done, and especially if they're receiving, they're not expecting as big an income, refund as they get, then they're really happy, of course, if we get a more refund. And it's our job to get them the maximum refund possible. Mm-hmm. So, and that's why it's better to come in to a professional so that we can get you the maximum refund possible.
Now, Asar, your company does taxes, but you also do financial consulting. So what do you advise people to do with that refund?
Well, first of all, if the refund's over a certain limit, the first thing I always tell them to do, and the limit I have for me is $1,000. If you're getting back more than $1,000, we need to first adjust your W-4 and try to figure out how to
let you have that money during the year.
Have that money during the year, because you're just giving the IRS an interest-free loan, especially if you have debt that you're paying and you're paying interest on that debt. It just doesn't make sense to give IRS an interest-free loan and you're paying typical loan amount now 7, 8, 10, 12%. Mm-hmm. So one of the things I always encourage is to take that money from your refund. Let's eliminate some debt so we can now use that money to reinvest and learn how to make your money work harder for you than you working hard for that money.
Absolutely. We have a caller who couldn't stay on the phone, but she wanted to know if she can deduct the tithes that her children pay to the church.
The tithes that her children pay to the church. Mm-hmm. That's a good one.
Yeah, that one stumped you, huh?
Well, did you get the children the money? That's what I say. If you gave the children the money to put tithes into the church, then yes, you could. But
because that really is your money.
It's really your money. But if it's really the children earn the income and they deduct it, probably not, because they're not going to qualify to be able to use itemized deductions to deduct that tithes. Typically, in order to deduct the tithes, you got to be able to itemize. And if you're claiming them as a dependent, they probably don't qualify to do itemized deductions.
Oh, okay. Philip joins us from Virginia Beach. Hi, Philip. You're on the air.
Hi. How you doing today?
Okay. Go ahead.
Sorry?
I said, go ahead. What's your question?
I got married last year, 2011.
Congratulations.
Thank you. And my wife is a non-resident alien, so she's not inside of the country. So I don't know if it's better to just file single, like by myself, and then if she has to file anything or not, since she's not a U.S. resident and doesn't earn any income here.
Sorry?
Does your wife have a TIN number, a tax identification number?
She has a Social Security number.
Oh, good.
For the U.S.?
Yes.
Then yes, you can claim her as a dependent, and it's more advantageous for you to do that.
Because I was reading on the IRS website, and it looked like if I did a married file jointly, since she's a non-resident alien, that then they would tax her income overseas, and I wasn't sure if I understood that right.
Yes, they would do that as well.
That's correct. Yes.
So what are you saying to him? He has to file married filing jointly.
Yes.
Okay. Did that help you, Philip?
I think so. I may seek a professional advice.
Now, did she make her income overseas or in the United States?
Overseas. She has no U.S. income or holdings.
Now, did she pay tax credits? Did she pay taxes overseas?
Yes, she pays taxes in her home country.
Okay, well, you will be able to offset that. Yes, seek professional help on that one, because you'll be able to deduct. You'll get a credit for those taxes she paid overseas, and you might not actually end up.
So they don't necessarily double tax it then?
No. You'll get a credit for the taxes paid overseas.
And you can also do married filing separate.
Right. Okay, cool. Thanks.
Okay, you're welcome. We got time for one more quick call. Beverly is calling us from Norfolk. Hi, Beverly.
Hi.
Go ahead. What's your question?
Oh, no, my problem is the IRS told me that I cannot continuously make installment payments on my taxes. I'm a 1099. I'm self-employed for 7 years. I have no medical income. I pay a mortgage. I pay my taxes every year. A couple of times I refinanced and paid them. Oh, yeah, they charge you fees and interest on your installments. Pay them every year. Last time they told me we don't have to let you be on an installment plan every year. Well, I don't make enough money to pay the taxes in advance. So now what do I do? I want to know why big companies get write-offs and get, bailouts, but little people like me that make $30,000 a year, I'm a grandmother.
Okay, Beverly, we're just about out of time, so let's let our experts answer you really, really quickly. Go ahead, Rhonda.
Yeah, that's the rules. The estimates is what you need to pay.
So you want to add to that, Asar?
Well, you say you're making 1099 income. You're talking about 1099M income?
She's not
miscellaneous.
On miscellaneous income. So if you're making 1099M, make sure you don't forget about your tax deductions from having your business to offset some of that. So
okay. And we are out of time. Thank you so much, Rhonda Hayes with H&R Block and Asar Gray with G&G Associates, a tax and financial consultant service company. And we'll be right back. Hi there. We're back. Imagine never selling or doing drugs, but being sentenced to almost 25 years in federal prison for associating with someone who did. That's just what happened to Kimba Smith when she was a student at Hampton University. And she would still be incarcerated had it not been for President Bill Clinton, who granted her clemency in December of 2000. Since then, Kimba has emerged as one of the country's leading advocates for changing the country's federal drug laws. Kimba was in Norfolk this week as keynote speaker for the Norfolk State University's Honors College, and she shared her story with our Lisa Godley.
The fact remains is that I still have friends who I met who were incarcerated who have already served 18 years, first-time nonviolent drug offenders who have a life sentence and still don't have a release date.
Whether she's lobbying on Capitol Hill or traveling around the country calling for more reasonable sentences for drug crimes, Kimba Smith Pradia speaks boldly and with conviction. Her demeanor is a far cry from the Hampton University freshman who struggled with poor self-esteem.
Then I've noticed this particular individual guy that would come on campus in different cars, and people seemed to wanted to be around him or be his friend, and I would see him pick up other girls on campus. And so when it came the opportunity for us to meet and he started having a conversation with me and, we had this relationship, it sort of validated my existence on Hampton University's campus.
His name was Peter Hall, and he ran a crack cocaine ring. Kimba's association with him brought her the approval she was seeking from her peers, along with expensive gifts, nice cars, and fancy restaurants to dine. But it came with a price.
I thought that, I was in what I thought love could be at that particular age, and then the love turned more so to fear.
Kimba says Hall became abusive.
Was that more because you were in love or more because of fear?
More because of fear.
Okay.
Because when I moved out there, he had killed his best friend because he thought his best friend had cooperated with the authorities. So it was more so fear because I felt as if I had to do whatever it was that he told me to do because he had been to my parents' home, and I was fearful that, he would go after them because he felt as if my parents were responsible for the federal government coming down on him because they wanted his daughter back.
The two moved from city to city, and Kimba soon discovered she was pregnant. They decided it best she return home to her parents. By the time she did, there was a warrant out for her arrest. Kimba turned herself in, and although she never actually handled the drugs, she was charged with trafficking 255 kilograms of crack cocaine, money laundering, and making false statements to federal agents. Since sentences for drug crimes are based on weight, Kimba was sentenced to 24 years, 6 months in prison.
When they read that sentence to you, what were you experiencing emotionally at that moment?
You know, Norfolk brings back memories of that because, you know, my case was out of the United States District Court here in Norfolk. But it made me kind of tune out, but try to keep my physical outwardly appearance together because there were several supporters in the courtroom, my mother, my father, community members, the ex-mayor of Richmond, a Secret Serviceman who testified on my behalf, and, you know, expert testimony. But it was more so just me trying to not, you know, collapse and just want to give in to hearing 294 months in federal prison.
Kimba served 6 years before President Bill Clinton granted her clemency. She now speaks out about reforming federal drug laws.
There's still a lot of work that needs to be done. President Obama did sign the Fair Sentencing Act of 2010, which anyone who's familiar with current drug laws and policies, there was a racial disparity with crack versus powder cocaine sentencing. I did have a crack cocaine case, but in the past, you were sentenced 100 times worse versus a pure cocaine case if you had a crack case, and that racial ratio was reduced from 100 to 1 to 18 to 1. So that is some progress. Some journalists and reporters say it was historical, but in my opinion, I think that it still should be 1-to-1.
Kimba says she would like to see an end to mandatory minimum sentences and wants leniency for women charged with drug crimes because of their significant others. Last year, she completed her first published work titled Poster Child, The Kimba Smith Story, and has been speaking to college students and people in corrections programs about her experiences and her hopes for change. For Another View, I'm Lisa Godley.
What a powerful story, I tell you. A lot of changes that Kimba has gone through, but is trying to make good out of a very tragic situation. Now it's time for some things happening in our community. On Thursday, March the 8th, the Chesapeake Community Services Board Substance Abuse Prevention Program presents a workshop called Bullying, It Starts With Me. Parents and caregivers will learn to understand the different types of bullying and techniques to bully-proof your child. It's at 6:30 p.m. at the Indian River Recreation Center in Chesapeake. Call 424-4238 for more information. This is especially timely in light of the school shooting in Ohio this week. And on March 8th, a workshop entitled How to Pay for College, a Financial Aid Presentation. It's from 6 to 8 p.m. at TCC's Portsmouth campus. It's free and financial aid and FAFSA counseling is available. Call 683-2312 to reserve your seat. It's sponsored by the Virginia Tidewater Consortium for Higher Education. And on Saturday, March the 10th, Delta Sigma Theta, Virginia Beach Chesapeake Chapter, sponsors Stop Before It Starts, a forum on teen dating violence. It's at the Parkway Elementary School in Virginia Beach from 10 a.m. until noon. It's also free. Call 816-8142 to find out more. And this Sunday, I hope to see you at the Hampton Roads Gazette Exemplar Awards. It's at 3 p.m. at the Royal Courtyard in Virginia Beach. The Exemplar Awards, Leadership in Community Service. I have the pleasure of serving as MC, and Reverend Dr. Kurt T. Houston will be the keynote speaker. I sure would love to see you there. These events and others on our website, anotherviewradio.org. Next week, Roger, Carol, Will, and Bill are back for the March edition of the Another View Roundtable. For producer Lisa Godley, audio engineer Perry Smith, Megan Herrera, who answered the phones, I'm Barbara Ham Lee. Have a fabulous weekend, and we'll see you next Friday at noon for Another View.